All right, welcome back, founders. We're here for part 3 of Better Understanding Equity Financing. We're joined by our Nail the Numbers Pro, Laurie Dmytryshyn. Welcome back, Laurie. Thanks for being here. I'm all tongue-tied and twisted. We are talking all about pros and cons of equity financing. And before we get into that, we've had an opportunity just to discuss this a little bit. The entire episode, we've been focused on talking about kind of the future of the business and the future opportunity of the business and growth. Yeah. And this is going to sound cliche and redundant. And of course, we've gone through a year unlike any other in history. Right. And let's talk about the current state of many businesses right now. And if you were to be approached by a business that's been operating for, let's just say, 5 years, but now has gone through this global pandemic, what are some of the flags for you, or what are some of the things that when you're looking at the scope of the business and the owner that you would just kind of be very resistant to getting engaged?
Yeah, I think, that's a great question, very difficult to answer. I would have to say that the first thing we're going to do if someone's coming to us, and they're in a cash crunch, we are going to look at the future. We are going to say, okay, what's the growth potential? Why are they in this cash crunch? Is it COVID related? Is it, what is the reason sort of for the situation they're in? But what we would do is, again, we'd have to really see good growth. We'd have to see, assets. We'd have to see just that ability for the entrepreneur to bounce back. And then what we would do with respect to our investment dollars is we want to make sure that our investment dollars are going to be used for growth opportunities. So, again, it's tough for us to just come in. We're probably not going to take your debt out. That's, not really why we're there. We want to put money into the business to help the business grow. So we'll be very specific on our sources and our uses of funds that we're putting in. So we'd say, working capital, we would say buying equipment, a whole bunch of different things. But again, if you're just looking for someone to take your debt out, you're going to have a hard time getting an equity investor sort of interested in doing that.
So thank you for that. I think that's a really important point for a lot of founders to hear right now, because I know many business owners are trying to figure out how do they move forward in the business. And I've heard a couple of people, I've had several founders reach out saying, oh, I'm not being able to access these loans. And it's because they say, well, I need to service my existing debt. And so kind of rule number 1 of business is have your money make money, right? Like especially with loans, like you want to be able to see that churn and that turnover with it. Okay, so when I think of everything that you've talked about for this episode, when we're talking about the pros of of equity financing, it feels like to me one of the pros right off the top is the founder doesn't have to start repaying principal right away, right? They have a little bit of they have breathing room before they have to start making any payments, unlike debt. Is that right? I want you.
Yeah, well, basically, yeah, because your equity is going in as cash into the company, right? So that actually, with respect to an equity investment, it often increases your ability to leverage too as well, right? So that you can take on more debt for your business if need be. So there's, equity is going in as shares, it's money going in, there's no, your repayment is essentially the exit strategy that you've negotiated, from the beginning, but that's probably going to be 8 years down the road. Did I answer that question?
I think so. I'm sensing founders' wheels kind of turning on that, because you mentioned a really important point about leverage. So let me see if I'm this right. So when you get an equity partner that comes in, it's altering your balance sheet, because now your debt to equity is getting revised, right? Now you've got more equity to debt because this infusion came in.
Exactly.
Because that's what's happening on the balance sheet now. Now your ability to access additional debt, should you need it, it grows. However, I would assume that this is a conversation that any founder would need to have with the equity partner before they start now going out to access debt.
No, and part of it, like I said, right, is you have to have a growth strategy. right? And so, and what's going to happen is when our money goes in, we're going to make sure we know where that money is going, right? So, you know, we like to come in when a company is expanding, right? So you've got an expansion. Let's say they're buying technology. Let's say they're, you know, they're doing whatever they are. Let's say marketing. Let's say they're hiring key employees. We want to see our money going in to those categories versus our money going in to pay off debt. So that's kind of, you know, my point is that we're going to be very prescriptive in terms of this is what the money is used for. It's not just money coming in.
Right. Okay, so so the money, it gets, and I would imagine this is in the term sheet, just like you said, how the money gets used, right, where that's going. But you've brought up this this interesting point that your balance sheet is now going to be altered because now you've got more equity than you have debt in there. And you bring up an interesting point just to sit on that for a second about a lot of tech-based companies. And I think we've got one, no, I think we do have one really exciting story here in Saskatchewan, which was a service-based business, right, in the hair industry. And then she decided to take her expertise in that business and apply that to tech, right, which was about, we're just going to find ways to build formulations without, you know, people having to necessarily come into the studio. So I know tech is a broad brush strokes, but there's lots of ways that you can apply technology to your passion. So the pros, we've got, obviously we're not getting stuck on principal repayments right away. That cash is in. You also mentioned one of the other pros is it's not just money, it's expertise, it's mentorship, it's network, it's connections, it's potentially future support in the in the situation where you might be in a jam. Now you've got a support system to say, here's what's happening, but always stay on top of your numbers. So let's just talk about the cons. What are some of the things?
Can I just add, can I interrupt? Because the one thing that I haven't raised, and it's something that I should raise too, is often sort of investors, if they're putting in a big enough check size and they're taking a big enough percentage of the cap table, so a big enough equity percentage of the entrepreneur's business, then they'll often ask for a board seat. And, you know, one of the things that we find absolutely, you know, in my mind, is critical, you know, with respect to companies is governance. And so what we always like to see with respect to entrepreneurs is, do you have a board in place? That's one of the questions we always ask. If not, we're going to, with our money, there will be a board in place. So we do find that governance is absolutely critically important. So I would say that that's, you know, that's definitely a pro too as well, because I think good governance makes good companies too.
That is huge. I'm curious, out of the questions or out of the founders that you meet with, how many actually have a board in place? What would that rate look like out of 10?
Yeah, I mean, it depends again. Early stage, I would say probably only half would. But we do, as I said, it's a condition of our investment is that a board is put in place. But, you know, on the more established companies, they usually have a board. It might not be a huge board, but at least, you know, there is sort of that group that is there helping the entrepreneur.
I love that. And we'll, because I think that dovetails into cons as well. But before we get into that, again, just, I know this is where founders sometimes have the resistance to go, you know, I started a business because this is what I want to do. It's my vision. This is what I want to build. Right. And then to have all these people saying, oh, not a good idea. And you should zig and instead of zag. And, but I think the value in that is, I know the value in it is that now you've got all of this expertise around the table that's really providing intel around what are the best decisions to make on behalf of the business, not the owner, right? The business. I mean, that's why big businesses have them.
Yeah, and we've sort of seen, like I always say, a great example kind of, you know, with respect to governance that we've seen in a company that is actually, you know, doing fantastic right now is Coconut Software. When Catherine came to us originally, that was sort of her first raise, you know, and I think she had a board in place, but they weren't meeting. Anyway, we ended up coming in. She ended up getting some really fantastic investors coming in. So we didn't end up taking a board seat because we didn't feel we could add value, you know, enough value, but she ended up, the investors that did come in, a couple of VCs and Neil Dempsey were just fantastic for her. So they sort of wrapped their expertise, kind of around that company. And it's absolutely amazing to see where she was when we first invested. And then now, thanks to, the awesome board of directors and the guidance and the support she's had through Neil Dempsey, it's just, it's unbelievable to see where she's at, really like 3-4 years later.
Yeah.
So,
what a great story. I think that serves as very powerful inspiration, because it does take a village to build
It
a
does,
business, right? You're not an
Yeah.
island. It just doesn't work.
So, and she recognized that too. She was actually profitable. It was interesting because when she came to us too, she wasn't sure, she was just kind of getting her head around. She had met Neil Dempsey, and I think she realized how much value he could bring to her business. But it's just kind of interesting to see now, just to see that whole mindset and the change. And how appreciative she is of that group of investors.
No doubt. So again, the village and the family and people there to support you and really help you grow, unlike the debt financing, right? This is like a group of people that are really, they're the wind beneath the wings, although they're the angels that are really there to help you flourish. So with that being said, when we get into the cons, I know many founders start to think of, but now I've got someone in my business. Maybe run through the cons that you typically, you hear founders talk about. And
so in terms of the cons, like what we hear from founders is, I don't want to give up control of my company, right? So we do hear that quite frequently, but we don't see it that way. We see it like you had indicated already, like we are there to help your company grow. And usually with the equity injection and with the expertise and mentorship, that gives you the ability to scale faster. And that's really what it's all about, is you're going to get to the end game probably a lot faster and you'll have a bigger pie, right? I think that's kind of the end game there. So we've heard that. Cons to, I think, as I said, it's really careful that you get the right investor, because we do hear sometimes entrepreneurs just saying, wow, they keep bugging me, they're phoning me all the time, trying to find out what's going on. There's a lot of that I've heard sometimes too as well, but I would kind of come back to them, and say, well, I mean, if you've got good governance in place, and you're communicating with your shareholders, you're, sending updates. Like some of our companies are just so good, like every quarter, right? They'll send a shareholders update. So the shareholders know what's going on, right? Versus, we don't hear anything for 2 years. And, I think, so there's a bunch of different things you can do. Just to kind of protect your own time.
Well, that's a great practice. I think, just like you said, the communication, right? Understanding the terms up front, how often that investor is expecting to hear from you. And you, just to bring back something that you mentioned earlier, bring it all out, bring all the dirty stuff out to the forefront. And then as you're in the process of building the business, there are ups and downs. And when you hit it down, don't go into dark mode. Don't go into silent
I agree.
mode, right?
Yes. We've seen that so many times, right? Where, the entrepreneur kind of will hit some speed bumps and not reach out to shareholders, until it's maybe the crisis is even, 1,000 times worse, where shareholders might have been able to help. So please, like we said, it's not just good. We don't want to hear just the good stuff. We want to hear the bad stuff too. We want to hear, what's keeping you awake at night? What speed bumps did you run into this last quarter? Like, that's all critical, because you never know when someone might be able to help you, right? Like, unless you're communicating. Yeah. So I agree.
Just like you said, it's a family, right? In many ways, it's like a marriage, and it's not all going to be peaches and roses, right? There's definitely going to be some tough goes there. So Laurie, what I'm including here in this episode, we're going to do a startup cost template. So if somebody is starting up, they've got that. We're also going to do a cash flow. So that cash flow forecast will show obviously top line, bottom line, and any sort of working capital needs, because I imagine equity partners want to know that, right?
Yeah.
Where are you using the money? How are you going to use it? And
Yeah.
I'm also going to include a checklist on back from my days when I was adjudicating and loans with Futurepreneur. It was, I think that was overwhelming for a lot of founders where they just didn't really understand how much information lenders actually want to see, whether it's debt or equity. So I'm going to put that in there. But what I've really taken away from this, so much value. Thank you for investing and sharing your time this morning. My big takeaway from this that I want to just kind of reiterate here is don't leave this to the last minute.
I agree.
Get these tools done, look at them. And Laurie, you're saying ideally a year if you can, a year to start planning because you're still in the business too, right? So this isn't a quick fix solution. It's due diligence, take your time. They're going to take their time looking at everything. Again, I so appreciate you showing up and doing this episode with us, Laurie. Thank you so much. If people want to get in touch with you, are you okay if we have your contact information in the show notes below? Okay, so that's where we can find that. And with that being said, then I just want to thank our episode champions, Community Future Sunrise. They are debt lenders out there, but it sounds like debt and equity can coincide quite nicely.
I agree.
Everybody knows what piece of the pie they're working on and getting that support as necessary. So thank you, Community Futures, for all that you do. Laurie, thank you so much for joining for the episode. So appreciate you and all that you do. And thanks for helping founders through this crazy time, and looking forward to seeing more Canadian success stories come out in the years to come.
I agree. And thank you so much for having me. This was great.
Always. All right. Thank you, founders. We'll see you in the next episode of The Gabler. Bye for now.